Ms. Asima Goel, former member, Monetary Policy Committee, RBI. And other panelists are Dr. Charan Singh, as usual. Normally, in the absence of the chairperson, he is always chairing. So, Asima is here. So, today he will not have the opportunity to chair the session. And yeah, advisor, Dr. Charan Singh, advisor, ASSOCHAM National Council for Banking and Chief Executive, EGROW Foundation. I was told that Sri Rajan Pental will be replaced by Sunil Minocha ji, and panelists Sri Sujit Kumar, Chief Economist, National Bank for Financing, Infrastructure and Development, Sri Abhijit Barua, former Chief Economist, HDFC Bank and Independent Economist, Miss Upasana Bhardwaj, Chief Economist, Kotak Mahindra Bank, Sri Indranil Sen Gupta, Professor of Practice of Economics, Shiv Nadar University, Sri Siddharth Sanyal, Chief Economics and Head of Research, Bandhan Bank, Sri Arjun G. Nagarajan, Chief Economist and Communication Manager, Sudarshan Asset Management Company Limited, and Sri Vasudev Mukherjee, Assistant Secretary General, ASSOCHAM. So first of all, I would like to congratulate ASSOCHAM for organizing and EGROW Foundation for organizing this shadow monetary policy MPC meeting. You see, last committee meeting of RBI was held on 6th December 2024. And in that, repo rate remained unchanged at 6.5%. Instance becomes neutral, and CRR cut by 50 basis point, and it has come to 4%, and nothing significant. So this time we are expecting, though business standard survey of economists, where 10 economists has pulled 9 out of that 25 paisa BPS will be deducted. That means repo rate should be 6.25. Considering global uncertainties, slow down the economy, as the second quarter GDP was 5.4%. Even the third quarter is slow. Consumption, slowing in consumption, urban consumption basically, rural consumption is okay. And in budget, we have seen fiscal prudence demonstrated in the budget, and inflation for the financial year 25-26 is expected at 4% in budget, and fiscal deficit is also controlled 4.8% this year, and 4.4% roadmap is given for 25-26. So RBI governor Sri Malhotra ji is taking the charge, Sanjay Malhotra ji, and he is expected to take what he took the decision is to be seen, because inflation in December is 5.22, though it has declined from this November 5.48. And so considering, and even January, though inflation has not been declared, but it is expected should be around 4.5. So he will have a greater challenge for growth as well as inflation. And though the roadmap is 4% in the coming year, so and economists has expected that 25 basis points should be reduced. So I think he can go reducing this fiscal this repo rate by 25 basis point. But I am thinking that 25 basis points should be reduced in April instead of this February. That is my own opinion, because considering so many things, I am expecting that since inflation is not under control so far, And liquidity, he has been, RBI has done in CRR, reducing 50 basis point and other steps taken recently. So liquidity is also in the system. So more liquidity can be considered instead of reducing repo rate. That is my personal view. And I think when RBI is comfortable, when inflation has gone down 4%, so then he can reduce even 50 basis point or 25 basis point. That is my personal view. Though last 5 years, no rate cut has been done, and 11, this will be the 12th consecutive policy when no rate cut has been done. And last 250 basis point has been raised in May 2022 to 23. So 250 basis point raised in very short period of 8-9 months. And after that, repo rate remains standstill, no rate cut, and it will be when Corona was there, May to 2020, only then the last rate cut has been done. So it will be 5 years. So that is my personal view. Still, he should take the bold decision not to do rate cut, because the Fed has not reduced, and moreover, if he reduced, money flows will be to US or other countries. Already rupee has been depreciated a lot, and there will be a greater chance that rupee will be depreciated further if you will do now. So we must wait that Fed should do a rate cut in the next policy, and then we should do it. Thank you very much. That is my view. I have done.
Thank you,
Over
Mr.
to
Agarwal.
Singhal.
Yeah, thank you, Mr. Agarwal. A good summary of what has been happening. But I just want to highlight certain features, and since there are a large number of speakers, I'll be very brief, and I urge all speakers to restrict themselves to 5 minutes so we can stay within our appointed time. We'll be following the order given in the flyer with our guests coming after Charan Singh and Apik, who has to leave. So although inflation has fallen as we expected in our last meeting, and in December it came down within the tolerance band, January figure is not yet out, but it's expected to be, the market expectation is about 4.5. So the current real repo rate is above 2%. And since for the year inflation is expected at 4%, then it's even forward looking. It is very high. Now the budget has been more conservative than market expectations. FD is coming down faster, and their growth assumptions are also conservative. So that gives room for monetary policy to ease. And also the budget highlights 4 growth engines, and the first among them is agriculture. And they take some action to improve vegetable supplies, which have been creating transient peaks in inflation. So that also gives some comfort to the MPC. And the corporate results that have come in over the past 2 months show the continuing slowdown, some reduction in profits for many corporates. The budget does have some stimulus, but I think we have enough experience over the past, starting from the 2010s, that whenever the real rate is above 1, we have a slowdown. So it seems that the interest sensitivity of aggregate demand is pretty high in India. Even research suggests this, and this should be one of the stylized facts we internalized when we are considering macroeconomic policy. Last time there was a worry that liquidity is tight, and because of the outflows, etc. But I think that time we had concluded that as long as the RBI has moved to a neutral stance, the intent is there to infuse liquidity, and they have enough tools to do so. So we've seen liquidity come into surplus, but the current worry seems to be about the rupee and the Trump and his tariff tantrums. So we saw large volatility just yesterday when the tariff announcement was made. Dollar index shot up, and then when he was always expected to use it as a negotiation tool. So he has postponed it. Then again, the dollar index has softened. The rupee will also likely soften. So there is a view, as Mr. Agarwal has enunciated, that times are too volatile, too uncertain. So therefore, we can't, RBI, the MPC can't afford to cut currently. But I think that we can't base our policy on this kind of volatility and tantrums. We should base our policy on what is suited to our domestic cycle, especially since monetary policy acts with a lag and we are already behind and we have seen the consequences in slowing growth. And moreover, the experience in the pandemic period when we had sharp outflows in certain, whenever there was a global risk off, we saw that this always reversed and actually raising, we saw least outflows when the differential was the lowest. So it would seem that our FPI, raising our rates does not keep FPI here. They do go when the US yield goes up and that's risk-free returns. But what helps keep them here is better growth prospects, FPI, which dominates. And even for debt, the rupee value is important. And so raising rates doesn't assure that the rupee will strengthen. So it's much better that we target the rupee towards the domestic cycle, the interest rates to the domestic cycle, while we have a number of instruments to deal with rupee volatility, and we've used them very successfully over the last 3 years. So, and what has worked post-pandemic is that macroeconomic policy stimulated domestic demand to compensate for external shocks. The traditional EM reaction is freeze, let everything be decided by what the big economies are doing. I think we are big enough now to have outgrown that. So the other concern voiced last time was that banks would suffer if rates are raised, especially since deposit growth was slow. But over these last 2 months, we've seen a lot of bank profit come in. Bank profits have been high in some banks, those who have grown credit at higher rates. So as I invite our guests to make our panelists and guests to make their remarks, I would ask them, those from special sectors and institutions, to tell us how a rate change will affect their institutions and also how a change in economic growth, a revival in growth will affect their institutions. So I now turn to Charan Singh. Your comments, please, Dr. Singh.
Thank you very much, Professor Ashima. As you have rightly said, and Agrawal, you also mentioned it, I think the broad macroeconomic scenario is in front of us. So I think I would totally agree with you on the rate card because the way we have space now, but let me share a few thoughts with you. If I look at the core industries data, which was just released on January 31, which is very, very recent, in all the sectors, be it coal, crude, natural gas, refinery, fertilizers, steel, cement, electricity, the growth rate for April to December is down. Right? So that's a very something. Though the economic survey had come, and I'm sure economic survey had captured data until 15th of January, but if you look at this latest core industries, now this slowdown, which is getting reflected in the core sectors, is again a manifestation of what was April-November data for IIP. In IIP also, manufacturing, mining, and electricity, they were down. So now that is a very something. You know, the second quarter was very bad. We were all disappointed. But the early signs of the third quarter are also not very interesting. Now, the inflation thing I would like to mention, and I must thank the economic survey team, they brought something very important to our notice. They said that in case we net inflation of tomato, onion, and potato, both the headline inflation is in the range of 4%, and food inflation is down to 5%. It's very surprising that just these three commodities invariably cause us all the disturbance in our inflationary calculations. Just one potato or tomato, and that's, I think, something we need to think through. And should we be hijacked by just these three commodities? I then would like to move on to the deficit and borrowing figure. I don't know if we have noticed it, but in the budget, the interest payment is going to be 3.6% of GDP. Our revenue deficit is 11% of GDP, 11.1, and interest payment is 3.6%. Our market borrowings this time for the next year are going to be 11.5 lakh crore, whereas in the current year, which will be closing, it will be around 10 net. I'm talking of net market borrowing, 10.7 lakh crore. In terms of borrowing, of course, we are doing a good job. As percentage of GDP, it's coming down from 3.3 to 3.2%. But the interest rate thing, which is eating away quite a significant chunk, more than 1/4 of the revenue deficit is interest payments, right? Now, in view of this, as you rightly mentioned, the banking credit trajectory is very good, and we have experts from the bank going to be talking to us in November and October, September. The bank credit trajectory is beautifully going around 11 to 12%. The non-performing assets are at this point amongst the lowest. Now, globally, so much of uncertainty. You mentioned about Trump. You know, the Fed Reserve also said there's so much of uncertainty on tariffs and other things. How do we really do? And so they have done a pause. But if you look at other countries, UK has come down, Euro has come down, and keeping that in mind, going forward, I would say that this is the right time when America has taken a pause, but we did not follow them in the last 6 months. This is the right time for us to adjust. Let me just summarize by saying, given the growth story in core industries and IIP, given that our interest payments as percentage of GDP are very high in the budget, the figures are showing us, and that if we are worried about capital flows, then I think given the situation, I would say a rate cut. Now then the question is, how much of a rate cut would I recommend? I would say 25 basis point the market is saying. I would strongly urge the RBI to go with that. But I would say because we delayed the rate cut and the environment is conducive, we have the governor who understands. The moment he came, he infused liquidity into the system. The disappointing figures of the second quarter in front of us, the third quarter is not showing a rosy picture. It is better to do a big bang, as Americans did. And I would say 25 basis for sure, 50 basis preferred. Thank you very much.
Thank you. Excellent points, Dr. Singh. So, it's good you have emphasized the effects of high interest payments, high interest rates, and negative effects through the impact on government ability to spend. And also, Shri Agarwal had said that the Fed has paused, but the point is the Fed has cut twice while we were on pause. So we have room. Our interest differential is larger now. We have room to cut. So Abhi, could you come in now since you have to leave?
I'm sorry. Can you see me?
No, we can't see you, but we can hear
I'm sorry.
you.
It's showing that I'm sorry. I'm in a car, so you'll just have to bear with this. I apologize.
That's all right.
Some
We'll
problem
listen
with
to you.
Yeah.
Go
Okay.
ahead.
So I'm going to sort of go ahead, say that I would have agreed with the chairperson and Charan just about 2 months back. I think there was an opportunity to cut the rates. But today, I think the situation that monetary policy is facing, the challenge, is not really a challenge to provide counter-cyclical support, but it is a challenge to manage a crisis which might just actually settle in the next couple of months. I mean, we just started seeing the US administration's tantrums, the threats, the counter threats, the withdrawals, and so forth. So I think the global sort of financial environment is very, very choppy. And in this kind of a situation, I am absolutely sure that going forward we need rate cuts. But I think the need to kind of protect financial stability, protect the rupee, etc., to the extent possible, I think dominates all other concerns at this stage. I think for was liquidity and not so much rates. And so all
We can't hear you now, Abhi. You're breaking. We can't hear you. Hello?
I will call Abhik on the phone and let him know we can't hear. In the meantime, Professor, if you could move to the next. I'll call Abhik right away.
So meanwhile, we'll ask Shri Sadaf Saeed, who's from Muthoot Microfinance, CEO Muthoot Microfinance, so can give us a lot of knowledge of what is happening there.
Yeah.
Yeah.
Thank
Please
you,
go ahead.
Ashmaji. Good afternoon, everyone. Thank you for giving me this opportunity and the platform. I think in my summary, there are a lot of major events that have played out before this monetary policy. Trump assuming the president's role, monetary policy of the Fed. Also, we have recently announced budget. So all of them will play a role in the monetary policy. Of course, I think before the previous governor stepped down or he was replaced, he superannuated. He had mentioned in his speeches before that RBI has played its role, and it's a time where fiscal policy also takes the mantle of taking the economy forward. I think in this budget, government has taken some initiatives, and if I can be specific about some of the initiatives for lending industry, or for that matter, the most important sector, which is MSME, is that they have completely redefined MSME as a definition. So the turnover caps and the investment caps have been revised, which I would assume will have a large implication, because there are around 7 crore registered MSMEs. A lot of them were not getting benefits of cheaper credit because they were not within that definition of the MSME or SME that was put together earlier. Now that has been redefined and the caps have been revised to 2 to 2.5 times. So a lot of those MSME will get the benefit of MSME credit, so cheaper credit would be available. That's point number one. The second thing, the governor, as he took the office, there are two significant step of liquidity infusion which has happened. One is the CRR cut by 50 bips, and then also there has been recent open market operations where 1,50,000 crores have been infused in the market. So that has also kind of created a lot of liquidity. I know there is still a demand, and definitely for credit growth that we were seeing earlier, it has come down. But the good part at the bottom of the pyramid is that the food inflation has come down. It has come down definitely. Further it can come down, but it has come down from the double digits, which it was operating to around 8.239%. It further will come down as the crop yields and also supply of food is there. So there would be more availability of cash for the bottom of the pyramid customers to pay. I think the emphasis from the government in this budget was on the consumption-led growth. So a lot of benefits have been given on the tax slabs. So money is left in the hands of the consumer to spend it judiciously. I'm sure this will propel growth. Also, it will propel from corporates and manufacturers to manufacture more, and which will lead to more job creation and hence more value creative to the economy. I think keeping that in mind and where the global economy is, where I've heard my eminent panelist also, we have the room for the rate cut. Because Fed for the last two times had a cut, this time they did not cut, and we haven't cut rates since a very long time. We anticipate a rate cut of around 25 bips. I think on the CRR side, already RBI has taken initiative. Open market operation has also happened recently, so I don't anticipate anything there, but definitely a 25 bips rate cut is expected.
Good, thank you. So maybe if I can ask you a question of how do you think a rate cut will help microfinance?
Definitely, I think one of the things that we are, as an industry, are facing is a challenge for the bottom of the pyramid customers for affordability of the installment. Because on one side, definitely inflation hurts the customer. Second side, the interest obligation also hurts the customer. So if the interest is reduced and we are able to pass it on, it will reduce the burden of installment for the customer and it will ease the repayment. So what we are seeing in unsecured rise in delinquency because of affordability challenges, that would definitely reduce to an extent. So I think it will be very positive for this segment that we are catering to.
Thank you. Thank you. Excellent points.
Thank you.
Professor Ashima, Abhik is back.
Yeah, he wanted to complete. Abhik, can you please complete? Sorry, we lost you.
Yeah. I'll just quickly. No, I'm just going to take a minute, and I would just like to say that I've been hearing the previous speakers, and I completely agree with the sort of the beneficial benefits and the imperatives of cutting the rate. But I still kind of want to emphasize that given the uncertainty, given the volatility, which is likely to abate going forward as the US government kind of settles in, we should look at stability and follow the textbook in keeping the rate on hold. The liquidity initiatives, which were very critical for banks, should continue, and I think perhaps they should provide some guidance. Maybe an open market operation calendar has been one of these guidances in the past. But at this stage, I would say stay neutral, hold, and provide enough liquidity. That's it from me. I'm sorry, I'm
Okay, yeah.
a little.
Yeah, thank you. Thank you. Good to get your perspective. But can I ask you one question? Like, do you think
Yes.
that a growth recovery will contribute to stability or hurt it?
No, I think at this growth recovery would certainly contribute to stability, but in a situation where the instability and volatility is concentrated in a very short period, I would think that just hunker down and batten down the hatches, and I just would follow the standard policy recommendation in these situations, which have been used in the past, which is to just keep the rate where it is.
So you don't believe in counter-cyclical stabilization in the external shocks?
I think counter-cyclical stabilization is certainly important, but counter-cyclical stabilization takes a while to. So this is all I'm saying. That this is a crisis which is likely to last for a few weeks, if or perhaps just a month and a half. In this period, I think the very traditional defense or the traditional stability measure, which is to keep the rate on hold.
Right. So you think the interest differential is
All
important to keep the rupee strong? But a higher interest rates in India.
Look, I think in a situation of extreme volatility, people take all kinds of cues from whatever is done, and in a situation where everyone is jittery, a rate cut, which is traditionally or historically or theoretically been associated with exchange rate depreciation, might just tip the balance. I mean, you're doing enough on the liquidity side. You've done quite a bit through the fiscal side, where one of your financial market variables are under extreme pressure. why not just leave
But
it be
but
for
is it
a couple of months?
research shows that a rate cut is not associated with depreciation in India. Anyway, we leave this there. Come back to the discussion. Thank you so much. Now we go to Dr. Sunil Manocha, who was with Capital Square Group and can give us the view from markets. Is he there? Dr. Sunil Manocha? He doesn't seem to be there. So maybe we can go to Shri Sujit Kumar, Chief Economist, NABFID. Is he there?
Good
Good
afternoon,
afternoon.
everyone.
Good afternoon.
So there is a lot to agree with the previous speakers, but I will still continue with the argument that I had made in previous meeting, that growth eventually has to come on priority. We have waited too long to see inflation head to the 4% target. And if below 5 is not comfortable, then I don't know what is going to be comfortable. We have been there for almost 6 quarters.
Right.
Right. Just a couple of readings above 6 should not alarm us. And we have seen eventually that in January, it's again going to be below 5 headline because of the moderation of vegetable and other components. On liquidity bit, I think RBI has done it really well in anticipation as well as now the response of 1.5 trillion infusion.
Right.
It should continue with it. I don't see CRR being put to use now once it has been already done. Coming to the external part, I am in complete agreement with Asima ma'am regarding having a different tool for managing that instead of letting interest rate do that. And addressing it to growth concerns, I think fiscal policy has done its bit. The capex tilt has not gone away despite having claims of having consumption smoothing. And net fiscal impulse, given that fiscal deficit as a ratio to GDP is down, is not very growth enhancing if we look from a relative perspective. So monetary policy has also to join in. It can't be working in different or opposite direction. So I will again go with my previous meeting call that we should take the opportunity to cut rate as and when it is available, and not mind too much on the external sector, which anyway is going to play out whether we have at 6% or 6.5%. It doesn't matter.
Right. Right.
Thank you.
Yeah, thank you. And if you give us some perspective from NABFID, how will a rate cut affect in any way?
See, for NAFID, actually it's both ways. Our liabilities are mostly through bond market, where the anchor is mostly GSEC. And GSEC is today tracking mostly the demand supply situation in that market. And it has already rallied a lot. So that way, the costing perspective has become favorable to us. On the lending side, because banks have their own challenges in deposit mobilization and their having rate high helps them in a way. So it's a favorable situation when interest rates are high for us. But still, I would think from economic perspective, we should not be waiting too long before it becomes really apparent that it's hurting us bad.
Right, right. I think because you would benefit from a higher credit offtake and so on, right? If there's more demand for project loans, etc. Right? There's also a very interesting argument from NABFED about how risk has been coming down in terms of so the risk weightage argument that if you look at current data, do you agree with that? Your MD had made that argument.
I think data speaks for itself. We have seen that almost for the last 4 years. There's hardly any default coming from the infra space.
Right.
And studies after studies have validated this. So we have to look at it afresh rather than going by 2015 history that we had a bad time. That's merit in there.
Yeah, thank you. Thank you. Again, very interesting points. Now, Upasna. So you got exactly what you asked for in the last meeting, the CRR cut. So how is Kotak doing, and what are your views this time? You're mute just now. You're mute.
Sorry about that. So from last time, basically we were arguing that if liquidity is not eased enough, then the any rate cuts will not really be meaningful. That was the whole objective of asking for more liquidity easing measures. And in fact, over the last 2 months, things worsened much more, if you would recall, in terms of liquidity. And that is the very reason probably RBI has now, provided for additional liquidity easing measures over the last 1 week. And I think if you look at the core durable liquidity, that has turned negative over the last few weeks, and that is expected to remain deficit despite these measures now. So what that means is that liquidity, in all likelihood, liquidity measures will have to improve going ahead, because somewhere the RBI's policy, which is suggestive of a neutral stance, also requires liquidity to speak in the same, which should be on the same level, right? So somewhere, I think if not the system liquidity, at least the durable liquidity should be neutral, to speak of the least, marginally positive, I would say. Because, and the other aspect is also that, we've been talking about durable liquidity means what is parked with RBI. We also take that into account and we talk about that. Government cash balances plus the net banking system liquidity. Now, with the new system of, central nodal agencies and the way the concentration of funds is and the just-in-time process of government system of spending, it has become a structural problem of liquidity for the banks. And as a result, the cash balances on an average tend to be high only and only come down off and on when, when the actual spending happens. So this has caused one basic structural change, I would say. It will take a while before the banking system settles to this new normal, but it is also one of the reasons. So when we look at the system liquidity, the overnight rates, which were much higher before the liquidity easing measures really settled in, one of the reasons was that as well. And hence, net LAF or the banking system liquidity becomes also equally important to look at, and not just durable liquidity. So I think we will need more liquidity easing measures, but at least it's a very good start. RBI has started this, and we know that there is acknowledgement. Just I want to touch upon what Abhik was referring to. In terms of global volatility, uncertainty that we have seen, I was of the opinion in the previous policy that, when there's too much of global volatility, clearly we should hold on to rate cuts because of the very reason which Abhik is also pointing out. But I also believe now, that time the policy priority was slightly different because we did see that rupee was being maintained very stable. So somewhere we saw that come what may, we were not seeing a very sharp move. Rupee was not allowed to move as per market forces. And that was one of the reasons why the call was there that probably we will not be seen, because interest rates will be used as a defense mechanism, to manage rupee. But today what we see since early December, rupee has been allowed to move, and it has been allowed to move quite a lot in line with market, directions. Since we would say this calendar year, at least last 1.5 months, last 6 weeks probably, rupee has moved very well in tandem with other peers. And that is also the reason that we have seen that probably in RER terms, now the overvaluation, which had overshot to above 108 levels, the index which had gone to above 108 levels, probably would have adjusted to near 105, 106 levels now. We don't have the latest data by RBI, but I think our estimates suggest that we would be in the range of 105 plus or so. So that correction has happened now. And yes, there will be volatility. But having said that, we cannot hold domestic monetary policy decision to the global tantrums which probably the US president is going to be throwing every now and then. So clearly now we need to realize where our priorities are, and if we are letting rupee act as a counter-cyclical measure, we are letting that move in the direct way in which it should be. I would say that there is room now which is there for rate cuts. And especially because we're saying inflation is settling down towards 4, like you mentioned already, 4.5%. We're also looking at next week. And after that, I think we'll be closer to 4% or so. I mean, that's how our tentative estimates are. So we're kind of graduating towards a medium-term target for RBI in the next few months. That is one welcome development. And at the same time, obviously, growth is much weaker than what we anyways anticipated few months ago. So that impact is getting visible. And I think the government has realized it. They have provided the right kind of stimulus to the consumers. And it is about time that we, from the monetary policy side, also see the similar impact. I also agree that there's not too much room for, honestly, rate cuts. I mean, so, it is not going to be that we can expect a 75 to 100 basis of rate cuts. But whatever scope it is, we should just give it right now so that the entire transmission happens and we start seeing a stabilization in the, real GDP growth of around 6.5% or so. Otherwise, there could be downside risks which would be prevailing. In order to anchor GDP even around 6.5%, we do need monetary support, whatever room that there is available. And I see 50 basis of rate cuts, but not immediately. I mean, I think right now they can do a 25 basis along with liquidity easing measures. And if global volatility subsides, then maybe back to back in April we should see. And otherwise we can wait for a policy and then act. But we can wait and watch and act. I think we are just talking about 50 basis overall in this calendar year. It's a matter of time. Starting off in February, they can go ahead with it. I think that is there. Talking about credit deposit, because liquidity is important, there are 2-3 factors which is affecting banking, the bank's liquidity system. I'll just mention a couple of them. We have this, because system liquidity is tight, credit deposit ratios are still very elevated for the banks. There is a kind of informal mandate by RBI to reduce the credit deposit ratios for each bank to, closer, move away from 80s and all to 75 levels. All of this is already adding to the stress. And at the same time, there is an added, I would say, a sword which is there, which is on the LCR guidelines for the mobile and internet enabled customers. So there is an additional 5% runoff factor, which is being talked about. We have tried to communicate to RBI that there should be clarity on that. It should not just immediately be implemented from 1st of April. There should be some time. It should be done either in a phased manner or some more time should be given. Let's see how some clarity is coming from that angle, because that is adding on. In a time when liquidity is tight, this very guideline will worsen the situation for the banking system. And that is the reason why there's been so much of chaos around tight liquidity. Deposit rates will not come down. So even if we do a rate cut, outstanding, because most of the loans are repo linked, outstanding loan rates will come down, but incrementally, because the cost of borrowing does not come down significantly for the banks, the transmission will not be 1:1. So the incremental loans will not be priced at a lower rate. So I'm just trying to put the things in perspective that there is a necessity to manage all of this. Even if the LCR guidelines have to come, new guidelines, they should be done in a staggered way, give banks enough time in a time when liquidity is more or less comfortable with the banks. I think this is not the right time for it. So yeah, that's about it from my end.
Yeah, thank you. Excellent reasoning. I agree that they should consider, unless they're able to expand liquidity, and I agree with you that it needs to be in surplus in the Indian system, slightly, given the kind of shocks we face. So unless they're able to demonstrate, and actually they have enough tools to adjust liquidity once the intent is there. We've seen them moving towards it. So we should expect it to become comfortable soon. But they can always stagger further requirements. That's counter-cyclical prudential tools, use them counter-cyclically. So, and I also think this acknowledgement that we have a number of tools to affect rupee volatility and the external sector. And we should not tie the interest rate to that. The idea behind a flexible exchange rate is that then the interest rate is free. But in a floating exchange rate, the traditional thinking. But in an economy like India or emerging markets, it doesn't work because there's over depreciation affected, and then it affects inflation, and then you have rate tightening anyway. So there's no point tying the rate to the rupee. And we have always kept a number of tools apart from reserves. There's capital flow management, there's lack of full capital count convertibility, there's RBI intervention, all sorts of things. So we should use all that. And yeah. Thank you. So then next is Siddharth Sanya.
Thank you very much, ma'am. I'd like to say that very clearly, I expect the RBI to continue focusing on the liquidity support part, there might be a need to enhance that further also. Having said that, I don't expect them to touch the CRR at this moment, the blunt tool, the knee-jerk tool at this moment. I don't expect them to deploy that again, given that they have done that very recently and it's at 4% kind of a level at this moment. It's fascinating to see the discussion on the rates side from all the previous speakers. I think in this particular policy, especially after the budget, there has been a very clear momentum in terms of the expectation tilting a little more in favor of a rate cut in the February policy itself. I think it's a very, very close call, especially if I take into account the part of the voting in the Monetary Policy Committee that we already know. That two of the voters from October or December onwards have already voted for a cut. It's very unlikely that they will say something else. And if there is just one more person voting in favor of a cut, it becomes very significantly strong. I take into account all these things. In this particular forum also, I see a lot of people in favor of a cut, but after mentioning that it's a very close call in my view because of all these factors, if I really need to choose one side, I'll go with what Avik mentioned, that at this point in time, I think there is very clear focus in terms of overall monetary easing through a weakening currency, through more liquidity support, proactive liquidity support at this point in time. But at this moment, the situation is way too volatile for me to very clearly support a rate action just yet. As in some cases, if we really convinced over the course of the next few weeks and next couple of months, there might be a better time to start on the rate action side as when the dust is slightly more settled. But my bias, I am very clear that it's a very, very close call in this particular policy, but my bias is not to cut in this particular policy. If needed, if we are so convinced 2 months down the line, maybe we can start with a bigger quantum even at that point in time. But at this moment, we are always thinking that whether we are getting hostage to the external sector, external economy, dollar, Trump, someone else. But if I think that if I see a rate cut today also, first of all, no amount of support on liquidity side at this moment is enough. Before I come to my points on the rate side, if I take a step back and see over the last year and a half what the RBI has done, I think one commendable thing that the RBI had done, that RBI had stopped the rate action at a reasonable level and didn't really go overboard in terms of hiking the repo rate way too higher compared to where they stopped. I think it was a great call on the part of the policymakers at that point in time. But if I need to see holistically what RBI possibly could have done better during 2024, even before the current situation of Q4 of calendar year 2024 emerged, our view had been that on the liquidity side, RBI even at that point in time possibly could have done better. I acknowledge that we are on an inflation targeting framework where you actually treat monetary aggregates as endogenous. But having said that, we saw a protracted period of 2.5 years, where you actually saw reserve money growth, the primary source of liquidity in the market, at around 6% or sub 6% level, in marked contrast to the long-term trend of 12 to 15%. I think to some extent, had we been doing the liquidity, stepping up the liquidity support a little more at that point in time, and there was enough flows and enough accretion of NFA at that particular point in time, things could have been a little easier at a later stage. Having said that, I think at this moment, we don't know, because the elephant in the room is the FII flows and capital flows. So we don't know the amount of liquidity that we have given, whether we need to offer a little more offer a lot more over the course of the next few weeks and next couple of months. I think it's better not to let go the most traditional form or the first line of defense. That's the interest rate defense to the currency. I'm not particularly worried about any particular level of the currency, but even then, at this volatile time, letting go that line of defense is possibly not the most preferred choice on my part. If needed, later on we can catch up with a larger quantum. And also the last point I would like to make, that let us think of a situation that at this moment we start cutting and keep cutting at a measured dose, or we join the we start cutting at a little later and start with a slightly higher dose. What difference will it make? Will it make a huge difference on the part of some of the projects taking off, some of the investments coming up, or it will go actually to some of the loans and consumer loans, which are typically external benchmark linked and will get immediately a benefit? My sense is that you might actually end up seeing a bit of external benchmark linked consumer loans again jumping up because of a cut, not necessarily a lot of projects taking off just because of a 25 basis point rate cut. For the overall for the economy, including in this particular segment, I think if we are much more clear about adequate availability of liquidity, and RBI has thankfully made its intention very, very clear on that, I think that's the best thing at this juncture they can do, not necessarily jumping onto a rate cut. Having said that, I completely acknowledge it's a very, very close call, particularly given the revealed preference on the part of a lot of MPC members already we know. I'll stop here. Thank you.
Thank you. Interesting. But just a question: are you saying that we should give up inflation targeting and move to a rupee peg? Because under inflation targeting, the MOU RBI has with the government is that we react to inflation and growth second. Inflation first and growth second, under flexible inflation targeting. But you and Abhik seem to be arguing for the interest rate defense, and therefore we should not cut the repo. But you know what matters for interest rate defense is very short-term interest rates. And yeah, what we have to aim for is a longer-term interest rate that affects real decisions, investment, consumption, and affects the real economy. Yeah, and these work with a lag. So you're saying, what difference will it make now? Already we are late. We should have started 6 months back. The lags are 6 months. So we are saying that it doesn't matter if we grow slowly another 3 months, but then there can be a tipping effect, you know, that animal spirits fall, growth is falling. Everybody will say the government, nothing works. They've given so many corporate tax cuts. Now they've given consumption stimulus, nothing is working. So, you know, you need the different parts of policy to work together. So you have some response to what I said, or should we go to the next speaker?
No, I think I see the point you are highlighting. But the question, and obviously there is no second thought on the inflation targeting framework at this moment, we are saying.
So we are in an inflation targeting framework, not a rupee targeting framework. Yeah. And as Upasana was saying, now they let the rupees flexible, it's also adjusting. So that also frees the interest rate for domestic concerns. Yeah.
That's true, ma'am. But at the same time, if I may respond to what you say, that at this moment, if you actually offer, if it's more important at this moment just to, flood the market with liquidity, which we have done a lot less going back in the last few months, when we could have possibly done it a little more. Your animal spirits, etc., might actually get a stronger support with the promise of an easier interest rate, but assurance of liquidity at this moment is my take. At this moment, if you cut, you will at a smaller quantum.
Yes, right. I agree with you that liquidity is important.
You will end up the banks will end up giving more consumer loans and not project loans.
I think we'll go ahead to Arjun Nagarajan for his view, the market view.
Sure. Hey, good afternoon, everyone, and pleasure to be here as always. Thanks a lot, Mr. Singh, and thanks, Ms. Goyal, for having me. I have another 5 minutes. I'll try to finish it well within that. For nearly a year now, I think my view has been pretty much the same, a pause in rates. I continue to sort of expect a start of rate cut only in FY26. Now, my core reason then was uncertainty in my last call, and I remember Ms. Goyal disagreeing with it in our last conversation. So my core reason remains the same, with particular focus on the external sector, part of which was present in my earlier views as well. Now, my views partly echo what Mr. Barua was mentioning, and also partly echoes what Mr. Sanyal was talking about. Now, while the core reason has been the same, we don't need a rate cut now, and that India is not seeing a slowdown independent of a sharp slowdown we witnessed over the last few quarters from the government spending, especially on the capex front. And we've seen this clearly reflecting in much lower operating profit growth of listed companies, exactly in line with the drop in government capex and government spending, and this feeding into lower manufacturing GDP and headline as well. Be that as it may, for now, I think the need to stay the course is even more important given the sharp FII outflows from equities that I think can start from debt as well quite soon enough. Markets expect bond inclusion. They expected bond inclusion in the first 10 months of inclusion from July 2024 to bring in roughly around $25 billion or so. Only 8 billion has come in so far into the FAR segment. More importantly, if you look at it from a fully hedged India investment into 10-year yields, from an FII point of view, that is well under what the US 10-year yield is currently giving you. And that spread has turned negative. So I fear that if the uncertainty continues, you will see FII equity into debt also drying out, which will give much more pressure from a rupee point of view. Now, in addition to these risks that loom, one must note that almost all of the additional domestic liquidity deficit that we saw in the last few months was linked directly to the RBI's FX intervention. And since November, the RBI appears to be continuing this intervention in double digits. That's what some broad estimates sort of suggest. Therefore, I continue to feel a pause would be more appropriate. Also, given that Mr. Malhotra's maiden monetary policy, I think the need of the hour is to bring about more continuity in the narrative and not pander to the market expectation of a rate cut. What I think would be more likely would be another 2 sets of 600 billion of OMO purchases, given the the large scale of FX intervention that currently appears to be underway. So the 600 billion plus the swap that was delivered now, I don't think is enough for the time being. I think I'll stop there. Another 2 minutes left and done.
Yeah, thank you. So, you were talking about pandering to the market sentiment. The RBI or the MPC does not pander to market sentiment. It reacts to.
I was just being a little populist.
To the relevant data, right? But this issue of not adequate debt flows and the sensitivity to interest rates. You think they're really sensitive to interest rates or to rupee depreciation and to risk premium, which have come down?
And so fully hedged
because of Trump.
So that uncertainty. If, for example, if I were to reconcile the differences in my view and yours, I think the core will boil down to just one. Personally, from 2014, I've not really been a very great advocate of inflation targeting. I feel a multiple indicator approach that the RBI followed earlier, I feel is more appropriate. Be that as it may, this is the reality that we are living in. My only point is that even if one argues for a rate cut, I feel this probably might not be the time now, given these pressures can exacerbate if a cut is delivered now.
But but you still haven't answered my question. That is, how important is the interest differential? What about the rupee value? What about risk premium? And if the indexing has not led to as much inflows as expected, one argument is that India is too small a country, for the big pension funds, and that is one major reason adequate inflows have not come in. So it's not related to the interest rate at all. So why should you tie the interest rate to some place where it's not very relevant? And when it's sort
Yeah.
of against your current policy framework as well as the needs of the domestic economy.
So,
When you have
if I
extreme
look at
volatility with Trump tantrums, you can't adjust your policy to every bounce Trump takes, right?
Exactly. Which is why I feel one has to be extremely careful with any policy move, because once you've made that move, you can't really go back on the move.
No, but you are not making a move because you're afraid of Trump. So should you be so afraid? I mean,
No.
don't you have
It does have an
other
impact.
levers?
Global growth does have an impact in India. That is one. And second, if I look at completely hedged, say for example, your 10-year is at let's say 6.7, 6.8, hedging your rupee, a fully hedged position will probably give you just around 4%. When US 10-year is giving me 4.5%, and this incentive to invest in India was there since July. In Jan, it appears to have shifted, and the spread has turned negative. So that incentive for an American sitting in US dollars is no longer there, even on a fully hedged basis, to invest in India 10-year. So that is my concern from an FII flow point of view, which is not a very great indication. So two things have to change for this incentive to come back.
What is the percentage of debt flows in India compared to the total inflows?
Sorry?
What is the percentage of debt flows compared to total inflows in India at present?
So FAR, we've received around 8 billion. Almost all of the flows that we've actually gotten is through the FAR segment. So if the bond inclusion hadn't
total flows, including equity and FDI and so on. Anyway, I think we can get into that offline. So because we don't have time. So now it's 1 hour is up, and we turn to any questions. There seem to be a lot of comments on the chat. So there's a question on moderating risk weights for credit cards. Yeah. Prudential regulation. Anybody has a view on this? Some bank economists? Moderating the higher prudential weights on credit cards. Is that something you would ask for? Upasna?
I don't know. I can't see the question really, but what is the question about?
It's about these higher risk weights that were put on credit card loans. So they're asking if for
at this point, I think the unsecured lending, basically, if you go back to the October policy and wherein, we had seen excessive, bombardment by RBI on restricting the unsecured lending. Honestly, I don't think yet there is going to be a relaxation on that front because, in a slowing economy, you tend to see the possibility of such mishaps much more. So the macro-prudential norms will need to be in place. And hence, I really don't see that reversal immediately. I think they'll have to wait and watch to really reverse. I mean, that's the only thing I can think of right away. But yeah.
Yes, completely.
I don't think that's
completely in agreement. And in the recent past, we have even seen a very significant change in risk-taking pattern of individuals, where not necessarily you are restricting your credit card borrowings just to your traditional borrowings, but possibly you are thinking it as a for some of the leveraged investments also. So I think there is every reason to stay very, very cautious on that.
Right, I agree with both of you that it's unlikely to moderate, and that 32% growth is risky and needs to be moderated. But that is another argument for softening on the aggregate. When you're able to target sectors where there's excess risk and reduce the risk there, then you can go easy on other sectors where you need growth to take place. So the another question seems to be more about, from Deepak Agarwal, seems more about budget and sort of, this is, if I just summarize the question in what I have understood, because it's very long, it's written, is that the view seems to be that leave growth and so on to reforms. That's a view one hears very often, while monetary policy should just not worry about it. So do the panelists have any, any view on this?
Sorry, I didn't understand the question.
From what I've understood, so this is my understanding of the question, is that they are saying that it is reform, GST, rate rationalization, etc., which will supply chain manufacturing and so on, which will really affect the cost of capital and so on.
I think he's talking about
factors are
200 basis of, I'm sorry, they're talking about 200 basis of rate cuts in 4 tranches. I get that. Okay. I mean, you need to also look at, the output gap. You need to see where the real rates are and what is the scope of rate cuts that you can talk about. If you actually put the whole thing in perspective, then, most important, if you just go back to the golden era of India's growth, which was pre-global financial crisis, interest rates were high and yet investment growth was extremely high. So, it's also important. It's not just about the incremental value of rate cuts that you're talking about firstly here. Overall, I would say that it is important to get the consumer confidence, the animal spirits, all of that back in place to really get started with a higher growth trajectory. The private investment is not low because of interest rates, firstly. That's not the primary driver. There are other drivers and other factors which is actually keeping private investment low, despite government over the last 10 years being so focused on infrastructure, yet they've not been able to crowd in private investment. So yes, at the margin, wherever possible, we should be able to provide that basic hygiene of ensuring that we have benign rates. But yeah, such aggressive rate cut calls and all that. I mean, we can't afford an overheating also of the economy. We need to keep everything in balance, I would say. Reforms, yes, all the kind of reforms have to be undertaken, and there's much more to do, ease of doing business and other things, which is more on the fiscal side, which the government has to continue taking. I mean, that's the best I can give a view.
Right, and they are right. This question, Deepak is right when he's saying that Indian firms have a cost disadvantage. Rates are much higher here, and there is a whole. So one of the reasons I've been pushing in my term in MPC and talking just now about smoothing external shocks and reducing volatility and reducing risk premiums, because a lot of this differential, this comes from risk premium due to many things. You need reforms as well as you need lower volatility. So, but that is a long haul. At present, we make marginal adjustments wherever we have space and try reforms also, so that we can move in a direction where eventually capital costs much less. Charan, you want to add anything before we turn for the vote of thanks?
I think we have had a very good discussion, very divided house though.
Yes.
And Indraneel also wanted a rate cut. And I was looking at the SBI report, and the SBI report also recommended a 25 basis rate cut.
Right.
So
therefore, I was just
therefore,
totaling up from our participants, so including Indraneel. So we have cut is 6 and hold is 4.
yeah,
So the balance is slightly in the cut side.
on the cut side, yeah. So very, very, I think a very rich discussion. And today, for the first time, I realized that were we all, because there was more convergence last time, and I'm now thinking, were we all worried about the liquidity and not actually the rate cut? And now when the RBI has played this card so well, after both of them have left, the house is divided deep, right? So I think there's a learning up here. It was the liquidity which was causing the problem. And of course, there is the exchange rate volatility and the depreciation of the rupee is an added feature in this. So I totally agree with you. It's a little loaded towards the cut, but then there are strong arguments given by the people who are advocating the hold. Now, Dr. Rajesh, vote of thanks is by me, or there is somebody from ASSOCHAM?
No, sir. You can please conclude and give the vote of thanks. You are both we are from the EGROW side and as well as ASSOCHAM, sir.
Yeah, I know that. I wear too many turbans. Fair enough. Then I would like to conclude by thanking Professor Ashima Goyal to have chaired this session. which she would continue to in future. And I'm very thankful to the experts who have shared their thoughts, especially the one who are our experts from EGROW. They just had 2 days notice. I must say that we only decided on Sunday because last time when we were trying to do it earlier, everybody said that the budget should come first. So as the budget was presented, then we looked at the window and we said we'll do it Tuesday. So I'm really sorry to my colleagues in the shadow MPC that we gave such a short notice. I also want to thank Sadav, a dear young friend of mine, whom I only called in the morning to say, can you please come in? And he agreed. And we really miss Sunil Minocha. And Dr. Rajesh, if Sunil Minocha has a view and he's still around, we can, is he there? He is not joined. Okay, fine. So I want to thank all of you. Agarwal ji sets a beautiful trend every time we do it. And his analysis is always very sharp. And sometimes I wonder he's an industrialist or he's an economist. I have to look deeper and find out, but he gives us a very good overview of the two, industry and the academy. With this, I want to thank each one of you. We had a very good participation, about 30. I thought all of them are only invited. And everybody has shared their thoughts. The questions have also come in. So I want to thank each one of the participants who was here, listening to us patiently and sharing their thoughts, and to the panelists. And once again, thank you, Professor Ashima. I know post-budget how busy you must have been to have agreed to share this time slot. Thank you very much.
Thank you. It's been a great discussion.
Thank you so much.
Interacting
Thank you,
with all of you.
Thank you, Dr. Charan Singh, Dr. Asima. Thank you.
Listening to all the different perspectives. But if I was to summarize the divided house, I think it's a phrase I used in one of my MPC minutes, which is that in times of volatility, is it best to do nothing? Or does doing nothing add to volatility? I think that's where we have debate and disagreement. So let us see what happens in the MPC and what happens in the world as the Trump administration continues. But I have a feeling that maybe India, this volatility is going to be in India's favor, hopefully. Yeah. Thank you. Bye.
Thank you. Thank you.
Thank you.